All right, it's the top of the hour. My name is Trent Zimmerman, and I'm the director of annuities here at BGA Insurance. Uh, Sorry, let's try that again. Trent Zimmerman. I understand that I've condensed my name a little too quickly, and don't make it three syllables. I make it one. Um, so I'm the director of annuities here at BGA Insurance. BGA Insurance is a wholesaler for life insurance, annuities, long-term care, disability, working with independently licensed agents throughout the country. I myself have a bachelor's with a background in economics, a master's in finance. I'm a chartered financial consultant and certified life underwriter. And this is your 20-minute annuity Tuesdays. Today we're actually talking about life insurance and annuities and how they can partner together. I'll give some background. I've sat in more than a lot of hats at BGA, and so I know a good amount. Uh, if you come to me with a life case and it's not term or final expense, I'm going to send that off to somebody else to do. So this is, if you're going to ask me some advanced planning for permanent life insurance, I'll be able to give you an overview, but I won't be able to go into detail. I'm going to send that to somebody else. But this is how life insurance and annuities can work together, and that is something that we can talk about a little bit more in depth here. And if you want some more in depth on life insurance, you can join my colleague Steve Jones. He has webinars on Thursdays about every other week now. So, when we talk about life insurance and annuities, from my view, and if you've joined us before, you will have seen this before. This is comes from the work of Dr. Wade Pfau, that the best results in retirement come when individuals have these four things: an income annuity to cover the baseline expenses, some sort of time segmentation, some sort of equity growth, and some sort of risk wrapper. Now, and also the annuity, not necessarily always annuity. That can be a pension for some, but pensions are largely disappearing. So that's largely going to be income annuities. Time segmentation, MIGAs really work great here. Multi-year guaranteed annuities and fixed index annuities so that you can say, I'm going to take some risk off the table, not be able to take a loss, and put this into something that's going to either be guaranteed to grow or at least cannot diminish in that time. Your traditional equity investments for long-term growth because the stock market is the most consistently growing asset we have access to and the highest growing asset we have access to, but in the short term, it's the most volatile. So we want that long-term equity growth. And then we have the risk wrapper, which Dr. Fow himself says is a good example of that is cash value IUL. Something that you can pull from if your equities are down, so you're not uh, double down on a down year of loss in the market minus fees minus the income you need to take. And now instead of having to recoup 25%, we're having to recoup 35-40% because of the compounding effect of those losses. Uh, so cash value IOL can be a really good way. And this is just going to be the traditional look I have at it on it all. Besides the death benefit. But if we look at these two products individually, life insurance hedges against dying too soon, annuities hedge against living too long. We know this. But more and more, we see designs of annuities taking the place of life insurance and life insurance taking the place of annuities. And at the end of the day, they're designed for the complete opposite ends of the spectrum. They can do those things for each other and complement each other, but they're never going to be good at the opposite. An annuity is never going to provide good death benefit, although it can. Insurance is not going to provide as good of income, although it can, and it might have some other benefits from that income. But together they can cover a full spectrum of risk, especially when prepared with, or not prepared, paired with traditional equity investment and time segmentation. So the first way we're going to look at these things possibly competing is going to be the LIRP, life insurance retirement plan, using an overfunded high cash value policy to receive non-reportable income via distributions of the policy. So what does that mean by non-reportable? It's not taxable. You're pulling distributions from the policy, you're taking a loan from the policy, and that does not need to be reported as income. That does not therefore need to be taxed. And ideally, this is sold as a supplement to traditional retirement plans so that when you're maxing out everything else, you can still be putting extra money away. That's not always how it's sold, though. There's some, in my opinion, dangerous situations where we have new marketers, especially in the MLM systems, that are advertising this to be the best retirement plan you can get, and it's putting people at risk. So that's the first area we're looking at where they compete. We're also looking at premium dollars. That the client has X amount of money to put away. And so, is that going to go into the LIRP premium or is that going to go into annuity contribution? Do we want tax-free income or do we want taxable income, reportable income? And then client perception that if somebody has already sold them life insurance for a LIRP plan, they might say, I already have something that can do something similar to an annuity. I don't think this is actually a competition point, because I don't think a lot of clients are fully aware of this and are so in love with the plan that they would turn that down. I think that's more of an advisor perception. But when we compare the two, we're looking at a LIRP, the life insurance retirement plan, is non-guaranteed income, does not offset RMDs. It has a mortality-based death benefit, so that can be higher than the annuity. You can turn on and off income, which does provide you some flexibility, and it's non-reportable income, which can be good if you're in especially a high income bracket. Whereas the annuity is going to be that guaranteed income, guaranteed for life. Uh, if it's qualified funds, it can offset RMDs, and it's going to have a cash value based death benefit. Sorry, I didn't put death in there. So that's going to be a lower death benefit amount than you would get from the life insurance, but that also means no underwriting. Uh, Sorry, and I really screwed up this slide. Can only turn income on. My apologies. And increasingly reportable. And the average is about 40% higher income. So when I say increasingly reportable, uh, for those of you who might not fully understand what I'm saying there, uh, the taxable amount of that annuity is going to grow over time until, if we're talking about an FIA, the cash value is gone and it's going to be 100% taxable income. But in the early years, it's going to be less than 25%. And we've got about 10 to 15 years before it's 100% reportable and it's 40% higher. So if we're looking at somebody who's in a high income bracket in the 32% and up income bracket, maybe it does benefit them to get lower non-reportable income. But for majority of clients, that 40% higher that they're not going to be taxed 100% on for another 10, 15 years is going to be the better option, even if they are in the 32% tax bracket and above, that they know in 10, 15 years, I'm going to have less income. I can take this higher income amount. So we go back to this Dr. Wei Fao and we say, where do these two play together? And it's going to be that risk carpet that we already talked about. So we want to be using these in conjunction with each other that we can say, I'll take the flexibility of this LIRP to be able to pull in those down years and turn on and off income. I'll have the flexibility of this LIRP so that if I have a really high income year, maybe I can replace some of the income that I would take from somewhere else and replace it with the LIRP. And I know that if I die, I'm going to get a large, or my heirs are going to get a large tax-free death benefit from this. And I know that just taking that money out is going to reduce that, but that's worth it to me because I'm getting non-reportable income. I can turn it on and off. I'm not pulling in down years, and I can let my equities grow faster. And so we're going back to this concept that there is a number, that you never outlive your money, your core expenses are covered. Chance in a Monte Carlo analysis of complete portfolio depletion is less than 1%. In over three-quarters of historical back tests, you have greater terminal portfolio size when you just have an annuity, and you eliminate core concerns. And we see the benefits. We've talked about this every single week. 19% higher probability of sustaining income over 30 years, 10% minimum higher terminal wealth. You're going to have uh, a minimum of 10% more wealth at death than you would without the annuity. Now you add that life insurance on, we're going to continue to grow, but we get this portfolio freedom effect where we can allocate more to equities or to REITs or to foreign investments that we can see grow over a longer period of time. We're not forced to sell in down markets. We're going to slow that AUM depletion rate, and we're going to take some behavioral alpha off the table so that people aren't going to do what people are really good at, and that's selling low and buying high and following the trends. Because now we have two areas where the money is locked up and where they are not subject to that sort of volatility. And so we can let the riskier money continue to grow and not have to rely so much on it and not put so much emotion into it. Now, that's going to be the LIRP and annuity combination, and we're actually going to explore that more next week. I'm going to go into a deep dive of how you can use those to grow your portfolio larger over time, secure your retirement, and what I refer to as a bulletproof retirement. Now, where can they work together in different ways where you can't qualify for life insurance? Well, if you have a life decline, you can get an annuity with death benefit and guaranteed death benefit. And you can pair that with a final expense policy and you compare it with an AD&D policy, both of which will be guaranteed issue. And that way you're getting some leverage from the final expense policy on that for death benefit. You're getting the guaranteed death benefit from the annuity and something that's building cash value that you can convert into income later if you need it. And you're getting a accidental death and dismemberment policy to apply some additional death benefit in case how you passed was an accident. So annuities, we're now looking at when one doesn't work, can you use the other? Yes, you can use the annuities for death benefit. You can't qualify for long-term care. That's fine because we can get long-term care annuities, which are going to be much more lenient because they have no mortality underwriting. They do not care about when you are likely to die. They only care about your morbidity. How likely are you to go through a long-term care event? So it's going to be a lot more lenient in underwriting when we're looking at these long-term care annuities. And if you're outside the state of California, you even have guaranteed issue ones where you can still get a small amount of leverage on an LTC policy, and true LTC policies still can't qualify. The annuity can still continue to help because you have uh, annuities that have the ability to pay double income, or annuities that are just growth annuities that say if you have a long-term care event, we'll give you a 7 pay. And then the annuity will be completely depleted. That 7 pay annuity looks pretty similar to the doubled income, but double income lasts 5 years and then it drops down in half. And the 7 pay is 7 pays and then it's done. A little bit different depending on your client and what they want. But we also are looking at some annuities, and I mentioned this on here. Care Matters annuity is now available outside of California. It's been highly effective at getting people qualified for long-term care who maybe couldn't have qualified with the One America and Global Atlantic. So there are 7 ways to qualify for that in California for an out-of-state sale. So I do want you to know that. Um, and so when we have life cases, quote unquote, for people who can't qualify for life or qualify for the LTC component of life, annuities are still a great way to be able to fill those gaps, even though they're not going to be the best way. Now, if we're looking at people who have a life insurance policy and don't want it anymore, what can we do? The easy one is 1035 that cash value into an income producing annuity. The reason being is if you're healthy, you're not going to be able to sell that policy. It's going to be sold for a very low amount. You're not going to get your cash value back. And if you forfeit the policy, you're going to be immediately taxed on all that. But you throw it into an income annuity, you can spread out that taxable distribution over time, and you can have your CPA handle lowering the taxes on that. Or you can turn it even into lifetime income to supplement your retirement. If you are saying, I no longer need this death benefit, but I would like to be covered for long-term care, and the old policy I have doesn't have a long-term care rider. 1035ing that life policy into an LTC annuity is something that's available to you. That is still considered like to like. Now, the third strategy is one that we've been talking about more often, and I think it's a very clever way to handle this. That you say we have a strong cash value in this policy for somebody who's been putting in over life. They don't really need the death benefit anymore. They don't want to continue making payments to this. Um, and so they're wondering what they can do next. And they don't really need the income. The income might be nice, but they're wondering what to do next. And maybe they can't qualify for long-term care, or they already have long-term care. In a lot of these cases, they already have long-term care. Well, you can pull the basis out of the policy. And then 1035, the gain that's still left in the policy, into a new life policy. There's ones now that have very low internal charges, and the newer products are just better priced. So we're looking at an old whole life policy switching into an IUL with very low uh, internal fees and charges, and we were able to cut the premium in half on that policy. So we've taken the basis out, we've put the gain in, and maintaining the same death benefit, cut the premium in half. Now that basis all goes into an income producing annuity. And that income producing annuity provided enough for that premium plus extra. And they were getting at the end of the day on $1 million death benefit for somebody who is, I believe, 72. They were getting $21,000 a year in extra income. And the life insurance was protected. There was a new sale for the agent into a new life policy, and that basis was used to pay for the policy. Instead of just taking a paid up policy and reducing that death benefit, they could pay for life and continue to reap the benefits. It was a much better option for that individual than taking a reduced death benefit and just being done with the payments. And it resulted in a few more sales for the advisor and extra money in the client's pocket as well. Now, let's say we're going back to the LIRP and we're going to say that we're still pushing this LIRP policy. We looked at how they compete, we looked at how they can complement, and we're going to look at now more on the annuity side, what it can do for the LIRP. Now, if somebody says, I've worked my entire life, I've made high income my entire life, I've maxed out my 401k, I've maxed out my Roth, and now I've put everything into a LIRP, and I want to be taking distributions from this because this is what we've designed. At some point, because of the distributions you're taking from that and because of the large amount you've built up in your 401k, you are going to have a massive RMD hit. Now, as a reminder, Secure 2.0 allowed you to take annuitized assets out of the RMD calculation entirely if it's annuitized. So if we're talking about an FIA that has a rider, that's going to take some time for it to run out of cash value and become annuitized income. But a SPIA, a single premium immediate annuity, will be taken out of that calculation entirely, and the annuity income counts against your RMD obligation. So we can still use that LIRP plan that they designed, that they invested so much money into, but we can take the qualified funds and move money out of the calculation and use the income to offset to continue to let that qualified money grow. So that the annuities now, instead of being the main focus and the LIRP the complement, for somebody who's been very high net worth, building this plan for a long time, changing course could cause some issues. The annuity now can complement the LIRP sale by offsetting those RMDs. Now, finally, the one thing I want to talk about is this non-qualified variable annuity problem. We've seen a lot of non-qualified variable annuities come through here, and a lot of the people who have them don't need the income. They weren't planning on it. These were designed for tax deferred gain, and they do not have good income riders, are just saying, yeah, it's grown a lot. I'm going to keep letting it grow. The issue with that is because they've been tax deferred their whole life, they don't receive the step up in basis at death. They don't receive any step-up basis like you would in a normal brokerage account. So your heirs are going to be heavily taxed on that gain. And if you live past most of the time, 90, some of them are 95, you're going to be forced to annuitize. Those riders aren't good. The annuitization is even worse. They weren't designed to be annuitized. So you're forced annuitization at 90 if you live that long, and if you don't live that long, massive taxable, sorry for the word salad there, massive taxable distribution to your heirs. So what you can do is you can forfeit that policy. You can't 1035 it into life policy, but you can forfeit the policy, single pay into life to get some extra death benefit because you don't need that money. Or you can actually 1035 it into a period certain SPIA, pay your taxes out of the income, and take the remainder and put that into life insurance policy to increase your death benefit and to have that be a tax-free death benefit to your heirs. The added benefit is if you die during this period, certain time, they get the entire death benefit plus the income. And that income from that annuity would have need to have a liquidation schedule when it was passed on to the heirs. Now that's already built in. It's clean, it's simple, and you get an added mortality leverage on your death benefit for that individual as well. It's a great way to reposition money they weren't planning on touching, was designed for growth, but because of how it was built, has a massive taxable distribution. And we're going to touch on this here that let's say that you've built your retirement without an annuity. We're not doing Dr. Fow's strategy. And maybe you're a life insurance salesperson who's pushed LIRP a lot. Well, is there one last way they can pair together? Yeah, we're talking about the time segmentation and where MIGAs can play in. That if we're looking at the bond market, when you can still sell a bond at a huge loss, 57% in the late 2000s was the largest loss. You can still sell these at a massive loss if you need to sell in a down year. And right now, bonds and equities are moving together. So it's highly likely that both are going to be down. MIGAs can offer a solution for that. These bonds still have a good yield if you hold them to maturity, but you can build a MIGA ladder, multi-year guaranteed annuity ladder, that will have tranches of money come into liquidity every single year and provide higher yields than the bonds would, have similar liquidity and less risk. So you can still have that LIRP plan. You can still have that traditional equity for growth. You can still use that 4% rule for taking that money out for retirement, but you can replace the bond ladder with a MIGA ladder that will reduce the risk, increase the yield, and create liquidity tranches so you're not selling in a massively down year. So those are just some ideas. This has been more sales idea heavy uh, topic this week, but next week we're going to do a deep dive in how really the LIRPs and annuities can work together to make a really cohesive, bulletproof plan. If you have any questions, you can email me or call me. And if you need the fact finder to go through this with clients who've been talking to about that with advisors more and more, we can get that to you as well. And if you're looking for a lead system, I don't mention this enough. Or if you're looking for some more in-depth training on actually the meeting parts and going through those meetings with clients, we do partner with Annuity Giants. You'll see them on our website. You can get access there. It's an added cost. It's just a partnership that we do. It's not something that we've built in. But they do have a system in there for coaching you through the meetings and building a lead generation system. So that's available to you. Now, if you have any questions, you want to hang out, I'll be around for the next couple minutes, and that's your 20 minutes. Thank you for joining, everyone.